What's up, military millionaires? Today I want to talk to you about how to evaluate securities investments. Now, a security is a tradable, negotiable financial instrument that holds monetary value. It represents an ownership position in publicly traded corporations through stocks, bonds, or options. I realize I don't talk about securities or stocks and bonds very often, so I just want to touch on it. Now, first off, your Thrift Savings Plan invests in securities and will most likely be the first real investment that you make when you join the military. So it's worth understanding, and you should be investing in it. Secondly, you will hear a lot of people talk about investing in the stock market, and you need to know the good and bad side of that in order to avoid falling prey to bad investment advice or strategies. I cannot tell you how many times I've heard people give stock advice when they don't really make any money in stocks, so just pay attention. The two main types of securities are equities and debts. Equity securities represent an ownership interest held by shareholders, such as owning stocks. Typically, there's no regular payment amount with these, although many companies pay an annual dividend to their investors. You will get to receive any profit from the value of the stocks increasing, minus capital gains tax and all that when you sell. Debt securities represent money that is borrowed and must be repaid, such as bonds or certificate of deposit, CDs. You will receive a guaranteed rate of return over the course of time that you agree to invest in these assets, but this method does not allow you to benefit from profit generated. But at the same time, I mean, you don't have the risk of losing money when you invest in things like government-backed bonds. So, pros and cons. Now, there are hybrid versions of these, like convertible bonds or equity warrants, but you don't need to worry about those right now. We're just talking about stocks and bonds. You have undoubtedly heard about investing in the stock market. In fact, that's why I'm doing this video, because a lot of you asked me about what my thoughts were on the stock market, so we're kind of going to do a few videos about it. When you purchase a share of stock, you are purchasing a very small ownership interest in that company. So there are a lot of cool ways to invest in the stock market, but here are some of the ways that you should understand. The first is individual stocks. You need to be sure that you do some research before purchasing individual stocks. Too many people buy stocks based on, ooh, that one's going up, I need to buy, or ooh, that one just dropped, I need to buy before it comes back up. And while both of these strategies could have some advantages, you should never buy stocks based solely on past performance. And that's because, as with everything in life, past performance does not predict future performance. For example, as you've probably heard me say before, if you're playing a game with 2 dice and the number 3 has been rolled a lot, you still shouldn't bet that a 3 will be rolled next, because statistically 7 is the most common number rolled, followed by 6, then 5, then 4, and really there's only 3, 2, and 1 as on the back end. So you can see where I'm going. Just because the 3 had been rolled a lot does not mean it will continue to be. Statistically, it won't, at least not as much. So you should always try to remove your emotions from your investments in order to remain as objective as possible. And that specifically and most definitely applies to buying and selling stocks. When it comes to stocks, investing in short term can be lucrative, but I believe it is much better to invest for the long haul. Investing in companies that you plan to hold forever. That is how the wealthiest securities investors I can name purchase, right? Warren Buffett, some of those guys. And you should hold long term anyway. It's a good strategy. Now, the price to earnings ratio is one of the first things that I look at when evaluating a company. This ratio measures the current share price relative to its per share earnings in order to value a company. This is a great way to evaluate the value of a company's stock in an apples to apples comparison with other companies, because you can see if this company is selling for 6 times what it's earning and this one's selling for 20 times what it's earning, the 6th time might be the better deal. So the PE ratio is the market value per share divided by the earnings per share. If a company is currently trading at a multiple of 15 times, then that means investors are willing to pay $15 for every $1 of current earnings. So the higher the PE ratio, the more likely a company is to be overvalued. Now, that being said, a high price to earnings ratio isn't always a bad thing, and it can mean that investors are extremely bullish about the company. And so I like this number though, because it's a very easy way to look at a company and figure out how expensive each share is relative to how much money the company is making. And for the record, if I didn't touch on this, bullish means investors think the market's going to go up in value, and bearish means that investors think the market is going to go down in value. Now, this comes from the term bull market, trending up, bear market, trending down, and all that other stuff. For example, the beginning of coronavirus, a lot of people were very bullish or bearish on the market, and it tanked. And then it's starting to be bullish again because it's starting to come back up for whatever reason. Dividends are the next thing you should learn, and dividends are when a company distributes a portion of their earnings to investors. For example, if you own $100 worth of Coca-Cola stock and they were paying a 7% dividend yield, then you would get paid $7 over the course of that year for your ownership in their company. Now imagine if you owned $1 million worth of these same stocks. You could get paid $70,000 in just dividends. Now, when building your investment portfolio, I recommend that you reinvest every penny you get paid in dividends. And so that in the example above, if you had $100, you could take that $7, reinvest it into Coca-Cola or another company in order to produce an even larger dividend return the following year, because now it would be 7% of $107 and so on and so forth. This is kind of like cash flow reinvesting. Now, dividends are the stock market's version of cash flow that real estate investors target when buying properties. It doesn't get too much more passive than dividend returns, but that being said, companies can change their dividend returns at a moment's notice. In April of 2020, a lot of companies slashed or eliminated their dividend ratio when the economy kind of slowed to a halt. They did this in order to hoard cash from their profits to brace for the rough patch ahead, which was a really smart move for these companies. So I'm glad that a lot of them did it. Just you can't always bank on dividend yield. So I definitely like dividend stocks, and automatically reinvesting the returns from their dividend yield. But you need to understand that these aren't guaranteed. So just know what you're getting into. All right, next you need to understand the company and the competition, which is perhaps the most forgotten piece of analyzing a stock, and that's understanding the company. A lot of investors focus on the charts and the dividends and the news, etc., and they seem to just completely forget that the stock represents a company as a whole. So don't forget to analyze the company and not just their stock, right? You need to look at the company as a whole. So you should have an idea how the company is doing and whether or not they're in a good industry. Perhaps, investing in a taxi company, for example, when Uber and Lyft were taking off, probably wouldn't have been a good idea. So make sure you understand the company, their competition. Are they gaining market share? Are they getting beaten by their competition? Are they a physical factory or company that's getting beaten out by e-commerce? You need to understand this stuff. So is the company in a growing market or a dying industry? Blue ocean, like whatever. These are important questions to ask yourself if you're planning to invest in a company for the long term, and you should be rather than the short term. All right, what is the difference between index funds versus mutual funds and exchange traded funds or ETFs? So a mutual fund is a financial vehicle with a pool of money collected from many investors to purchase securities investments like stocks, bonds, etc. Mutual fund trades close at the end of the trading day, and the mutual funds are actively managed. An exchange traded fund or ETF is similar to a mutual fund, except that they are actively traded throughout the day, and ETFs are passively traded like an index fund. An index fund is a type of a mutual fund or ETF with a portfolio made to mirror the makeup of a financial market index, such as the S&P 500 index or the Standard & Poor's 500. Now, all of these funds have their place, but you need to do your research. You should know exactly what kind of securities your fund invests in, what their expense ratio is, how risky the fund is. Now, I'm a huge fan of index funds because they have an incredibly low fee structure for the most part, and the fact that you can purchase shares of an index fund that follows the entire market. I like the idea of investing in the market as a whole because I'm confident that in the long run, our economy will continue to do very well. So if you can buy a stock that just invests in the market, I feel like that's fairly safe, right? And safe, but still lucrative because the economy is going to go up. The Thrift Savings Fund has several index funds, and that is one of the reasons the TSP is able to maintain such low expenses. All right, so 401k and individual retirement accounts are IRAs. 401k and IRAs are tax-advantaged investment strategies, which makes them awesome. These accounts operate a lot like the TSP or Thrift Savings Plan, which I've discussed a lot in other videos. So I'm going to keep it somewhat brief here, but a lot of IRA and 401k funds invest in a mix of mutual funds, index funds, bonds, etc. And the most popular 401k funds are target date funds, which is honestly the best unless you plan on paying a lot of attention. So these are a mix of stock and bond investments that adjust as you get closer to your target date. So for example, if you plan on retiring in 2060, the target date fund will have a much riskier portfolio in 2020, and it will gradually purchase a larger percentage of bonds as it inches closer to 2060. So by the time you get to 2060, you'll have a lot more bonds in the portfolio, which will keep you from losing a large portion of your retirement fund if the market dips right before you begin to take withdrawals. Now that you understand the basics of these fund types, make sure you do your homework before choosing a fund to invest in. IRAs are not limited to just securities investments though, so there are self-directed IRAs or SDIRAs that allow you to invest in things like real estate or lend money to people and other creative investment strategies. While these are really cool, they're also fairly advanced and kind of beyond the scope of what I wanted to talk about today, so we're just going to wave top. Just be cautious when people try to convince you to roll your Thrift Savings Plan balance over to a self-directed IRA. You need to really ask what their compensation is for doing that and what the fees are, because unfortunately a lot of financial advisors make money off convincing you to move your money into their accounts, and it might not always be in your best interest to do so. Now, in my opinion, the 401k and IRA accounts are some of the best investments that you can make, and that's because of the tax advantages. I've made some other videos about that, so I'm not going to dig into that too much right now, but just know that tax advantaged and building on the market, pretty solid. I want to talk briefly about options. Options trading is a much more advanced way of trading stocks. This is where you can purchase an option to buy a stock at $20 a share if it jumps to $25 a share, which is a call option. So if it jumps to 25, you could say, I want to execute at 20, buy, sell. Now, if it goes up in value, you execute your option and you make money. If the stock drops in value, you only lost the little bit of money you had to pay for the options. You didn't lose the full amount that you would have invested if you bought the stock outright. Now you can also buy what's called a put option, where you buy a $20 share, and then if the stock drops to $15, you still have the option to sell at 20. Don't worry about this too much. Options are cool, but totally not what's necessary and not worth messing with until you have a really strong understanding of the stock market. In fact, most trading platforms won't let you mess with options until you've proven to them that you understand what you're doing. Now, the final thing I want to talk about for securities is bonds. A bond is a fixed income instrument that represents a loan made by an investor or a borrower. These are typically corporate or governmental and used to finance projects and operations. Bonds are great, don't get me wrong, because they are guaranteed interest rate and you receive a fixed return on your investment for the duration of ownership, so you can't lose money. So while the rate of return is often lower than you could earn with other investments, it is guaranteed, which means you will not lose money. I'm just going to reiterate that because that's great. Bonds are a great way to hedge your portfolio against risk. So I mentioned in the TSP section that life cycle funds are great because they gradually transition from the high risk, high reward to lower risk, lower reward as you get a little closer to retirement. And they do this by gradually making bonds a larger portion of the investment portfolio. Now, back in the day, you could earn a pretty decent return just by investing in bonds. Unfortunately, those days are behind us, and who knows if the yield they provide will ever go back up in value that much. Now, that being said, bonds are still a great way to hedge against recessions. So I wouldn't rely on them to build wealth, but if you amass a large enough amount of wealth and you want to ensure you never lose money, bonds are the way to do it. There are several different methods to invest in securities markets. Just make sure that you do your research and don't get wrapped up in the making an impulse, emotional decisions based on the daily stock price volatility and all other chaos, right? Don't take advice from people who aren't doing this successfully. And remember, simple and efficient is always better than wild and risky, right? Awesome. Hey, if you got something out of this and you want some more videos on stocks, I got a few more coming out. Make sure you subscribe and click that little notification bell. Have a great day.